Please, if you don't mind, if you can just share with us where you're joining us from, that would be beautiful. Your city, your state, that would be awesome. Thank you so much for joining, and welcome to the exciting world of multifamily meetup. Today is going to be an amazing, amazing guest speaker that we have here. He's part of ours, but he's a special person in the company. Sunny, California.
Yeah, California.
Yeah. How y'all feeling, XSITE team? See, everybody's ready. How's it going, Manny? You feeling good?
Man, I'm feeling great.
Born ready. Let's do this. A lot of people are trickling in right now, so we're going to give it a couple of more minutes and then we can go ahead and get started here. Then we're going to be talking about the very, very important fundamentals when it comes to buying large apartment deals. And this is an integral part of the entire process, like one of the most important part. And there's nobody better to do this than our guest speaker today, and I'm going to be introducing him here shortly.
Hey, man, I'm not a guest.
Yeah, you're our guest speaker today. You're special. You're part of the team, but today you're a guest speaker.
I roll with that. It's okay.
Hey, Dr. Nkema, how you doing? Thank you for joining. All right, I think we're going to go ahead and get started here so that we can be respectful of everybody's time. Welcome, everybody. On behalf of XSITE Capital, my name is Tenny Tolofari. I'm one of the co-founders here at XSITE Capital and the director of acquisition. Co-hosting this webinar or training with me, my XSITE Capital team members. We have our First Lady, Macy Price, right there. We have Miles Hill. We have Kayla Daughtry. And then we have Manny Awasom. Today, we have a really, really interesting treat for you all. As part of the process of acquiring deals, underwriting and trying to know how to buy a deal is an important part of the whole process. And we have a genius within XSITE Capital that has been leading that effort and has helped us acquire $168 million of asset under so far. So today, Manny is going to actually be going back, opening the curtain, and sharing with you all some of the strategy that we've used at XSITE Capital to acquire $168 million of asset under management. So Manny, he lives in California. I don't have to talk too much about him. He's part of XSITE Capital team. He is like a genius within the company. And I'll just let him go ahead and do an introduction of himself so that I don't take a lot of his accolade away. Let him do that work by himself. Please, if you're here and you're ready to buy deals, you want to understand buying multifamily real estate properties and how to underwrite the deal with the assumptions and all of that good stuff, Manny is the guy. So without further ado, I'll pass it on to Manny to please go ahead and kick it off. Thank you, Manny.
Thanks, Tenny. I appreciate it. So welcome, everybody. This is our final monthly meetup for this year. So I'm excited you guys could join us. Hopefully, you can walk away with something great from this meetup. Underwriting is one of the most critical, but the most boring part that most people don't want to do. So if you go to YouTube, everybody posts 5-minute underwriting, 15 minutes underwriting, but it's a very, very, very critical. And maybe I'm biased because I underwrite, but I think it's the most important component when it comes to acquiring multifamily properties. So because I didn't want to bore you guys with numbers, because most people don't like numbers and they want to understand the deal, how things work, I wanted to take a different route in presenting how we underwrite properties by going through a little sample deal. So this is interesting because the team doesn't even know what I'm presenting. So this is exciting for everybody else. So let me get started. Can you guys see my screen?
Yes, sir.
Perfect. Okay. You can see my screen?
Yes.
Got it. Perfect. Okay. So the topic for my presentation today is the anatomy of a multifamily real estate deal. Just a disclaimer, this presentation, the anatomy of a multifamily deal, is prepared for educational purposes. The content provided here is intended for general understanding of a multifamily real estate underwriting process. I advise all of you to seek qualified professional advice, such as an attorney, financial advisor, real estate experts before making any real estate investment decisions. Anything I say today is not financial advice, is simply to serve for educational purposes only. So if you are joining XSITE Capital for the first time, welcome. This is our team. We're currently led by 3 founders, Dr. Julius Oni, who's CEO, Leslie Awasom is the Director of Operations, Tenny Tolofaro is the Director of Acquisitions. Then my 3 other team members, Macy Price, she leads our Director of Marketing efforts. We have Kayla Daughtry, she handles the investors relations. Miles Hill, who works with me with acquisitions, and myself, I handle the underwriting. So just a little bit about me. So if you couldn't tell from the title of my presentation, I am also in the health field. So I'm a clinical pharmacist, and I've been a pharmacist here in Los Angeles for about 8 years. Previously, I worked as a technology consultant for Accenture, so I have an electrical engineering background. Started investing in real estate back in 2018 alongside my older brother, one of the founders of XSITE Capital. We purchased our first condo, and that is when everything clicked. So I started my financial modeling journey on multifamily investing back in 2019 when I was involved in a serious car accident. I was stuck at home, popping pain medications and numb. And I thought the best thing to do at the time was to take financial modeling classes. So while laying on my back, I started taking financial modeling classes. And also around the same time, I began underwriting for XSITE Capital. And during that same time, we've been leading an underwriting class every 2 weeks here at XSITE Capital, Leslie and myself. Because of some of the tedious and some of the hurdles I experienced underwriting, I started working on what I call the Microshift Analytica, which is an analyzer, which I am currently working on and should be coming out soon, and is meant to simplify the underwriting process, but that's for another time. In terms of my personal hobbies, I love everything fitness, real estate, crypto, and freedom, just getting your time freedom. Like I mentioned at the beginning of our presentation, I believe underwriting is one of the most critical components when it comes to acquiring multifamily properties. And I'm not just saying this because I'm biased and I'm an underwriter. It's because regardless of what your position is within your firm, you have to understand, if you don't want to run the numbers, you have to at least understand the concepts. So if you're in investor relations, you have to be able to talk to investors about their returns. If you're doing marketing, you have to understand that the stuff that you're putting out makes sense. And if you're raising funds, you have to have your investors interests, best interests at heart by understanding what you are doing. You can't just be raising funds and trusting that the operator that's bringing the deal to you is doing the right thing. And today, I will show you why you have to understand the importance and why it's so important, why it's so critical. So I have 2 goals today. One is to identify the risk associated with the evaluation and purchase of a multifamily real estate assets. And 2, the most important, is to provide you with the necessary tools and insights so you can capitalize on the upcoming opportunities in the multifamily space while minimizing risk for you and your investors. Unless you've been living under a rock the past year or the past few months, the news has been filled with headlines like this. And my favorite is the doomsday scenario, the distressed CRE loan surge nationwide, because it depicts what's currently happened here in the commercial real estate sector, especially with office. One of the most common and most talked about was the 3,200 units that was foreclosed in Houston, Texas by another syndication firm. Just a disclaimer before we go forward, I have no affiliations with any of the stories I just posted, those properties or the operators, nor did I invest in any of the deals. But one of the great things about real estate is that you don't have to understand what's going on. You can use numbers to tell a story. And that's what I intend to do today. So what do you think investors are thinking about when they see headlines like this? One of the first things, especially for a lot of people that were here back in 2021, when investors start seeing headlines like this on the news, especially investors that is not as savvy as the operators, the first thing they start thinking about is, oh no, my 19% IRR, will I still be able to get it? And the reason is because this was very common back in 2021. 19% IRR, 26% average return. My inbox, they were filled with deals having those returns that were promised to investors. So that is what investors start thinking as soon as they start seeing these headlines. So what are those returns? What is an IRR? So let's dive deep into that. When it comes to multifamily investments, there are few returns and they are all important that I want to talk about today. The first and the easiest one is the equity multiple. So the equity multiple is a measure of an investor's expected return for the equity they invested in the deal. So it provides insight in terms of the wealth building accumulation and risk. And why is that? That's because if you think about it, say you go to Vegas, you put $100 on red and red hits, you walk away with $200. So your equity multiple is 2x. So you double your money. However, there are limitations with that return metrics because it only tells you how much you invested in the beginning and what you got at the end. It doesn't tell you how long your investment, how long you invested in that deal. So if I'm selling you a deal and I only promise you, hey, you can get a 10%, 10x on your returns, and you say, oh, wow, that's a great deal. But that tells you nothing about the investment because that 10x could be 100 years. I am quite certain you will not take a deal that you have to wait 100 years to be able to get a 10x. So you have to understand the limitations with all of these returns. The next one is the average annual return. So this one is used to measure the annualized performance of a real estate investment. So it quantifies the profits or, this is important, loss from an investment over a specified period. The reason I said this is important is because average annual return sometimes can hide years of negative cash flow. And I'll give you a scenario. If I have two deals, the first deal, they're both 5-year hold. The first deal, I promise you 5% return each year. So you get 5% average annual return in year 1, 2, 3, 4, and 5. And the second deal, you get the same 5% average annual return over the 5-year hold. However, what I didn't tell you is that you're going to get 0% in the first year, 0 in the second year, 0 in the third year, 0 in the fourth year, and 25% return in the 5th year. Both of those deals have an average annual return of 5%. So you have to be able to understand those limitations when you see operators or you see an investment marketing like, oh, you're going to get 25% average annual return. You have to look deep into the hood to see when are those returns going to come to you. So in terms of the formula, the average annual return is the total profit that you get at the end of the investment period divided by your initial investment in the deal divided by the number of years. So unlike equity multiple, average annual return, it's good in the sense that it takes into consideration how long you are invested in that deal. So it is powerful in that sense. The next one, an investor favorite, is your cash on cash because it measures the annual cash flow generated from the property and relative to the amount of money invested. And so it helps the investors to understand how much cash flow they're going to be getting for each dollar invested in that deal. Keep in mind, cash on cash is only based on operational cash flow. So if there's a refinance or a sale, that's not part of cash on cash. And the reason I say that and this is something that you have to be important, you have to be mindful of if you're an investor, is that if you invested in a deal and there is a refinance, and some of your initial investment is returned to you, or all of your initial investment is returned to you, technically you'll no longer have any investments in that deal. For most deals, at that point, any cash flow you receive after that is just infinite cash flow, because it takes the annual cash flow divided by the total cash invested. But at that point, you've already been returned your initial investment. Why is that important? Because some operators might say, once you receive your total cash invested, then you're out of the deal. So you just have to be mindful and read the PPM when you receive those documents. But cash flow is an investor favorite because they want to know each year what they're getting. The last but not least, one of the most, I would say, important when it comes to investments, not just in real estate, also stocks and other investments, is the internal rate of return. If you were to Google what the IRR means, it is the discount rate at which the net present value is zero. That means nothing to a lot of people, but to break it down, what it's doing, it takes into consideration all your projected cash flows and it discounts it to today's value. And the reason it does that is because it takes into consideration the time value of money, which means money today is worth more than money tomorrow. So it calculates the time-weighted compounded annual growth of return. But again, there's a limitation with internal rate of return, because the internal rate of return assumes that whenever you get a return, you take that amount and you reinvest it in another deal that's going to generate a similar IRR as the deal that just gave you that same IRR. So if I invested in deal A and I get $5,000 and my internal rate of return from that deal is say 15%, this formula assumes that I'm going to take that $5,000 and immediately invest it in another deal that's also generating 15% IRR. So that's one of the limitations. It's a very complex formula that's usually calculated using Excel. And there are two types that you might see on a operator's pro forma. The first one is the IRR, and that just assumes that all the distributions happens at regular intervals. So that's like annually, quarterly, or biannually. The XIRR, which is the extended internal rate of return, allows for irregular distributions. So if you're doing monthly one period and then you're doing every 2 months, it allows you to take into consideration what dates those distributions are being done. So let's going back. So I mentioned the first thing investors are asking is like, what is my internal rate of return? But what I believe, in my opinion, once investors start seeing those headlines in the news, what they really should be asking is, where do I fall on the capital stack? So what is the capital stack? So the capital stack is a layer of capital used to fund a multifamily acquisition. So if you have a deal, $20 million, all the sources being used to fund that deal will fall in the capital stack. And the hierarchy is based on the risk, return, and the repayment priority. At the bottom of the capital stack is your senior debt. So the senior debt holds the property as collateral. So it assumes the least risk, because if anything was to hit the fan, the lenders want their money first. So they're first in line to collect their money. And typically they have the lowest risk, lower returns, and they have the highest priority for repayment. The second, and again, this is very deal dependent. Some deals may not have a mezzanine debt or preferred. Your typical deals would just have a senior debt and a common equity. But if you have a deal that has all four, then this is the structure in terms of the risk versus return layer. So the mezzanine debt, so it has a higher risk than a senior debt, but lower risk than common and preferred equity, because after the senior debt gets paid, mezzanine then gets the initial capital. Their returns tend to be a little bit higher than senior debt, but it could be lower than preferred or common equity. Then your preferred equity, they have a higher risk than mezzanine and senior debt in that order, but a lower risk than the common equity, because the preferred equity will get paid first before the common equity. The common equity is at the top of the stack. So they typically get the highest return because they can get the cash flow as well as any appreciation that's in the building. But when it comes to repayment, in the case of a default, the common equity comes last. So that's why it's important, once you start seeing those headlines, you want to pull out your PPM to start asking yourself, where do I fall on that capital stack? Because if you have a deal that has these 4 different sources, you are going to be the last to receive your money. But back to my doomsday scenario. Remember this headline? What potentially went wrong? Let's take a look. And in order to dissect this, I'm going to give you guys, we are going to create, and this is a deal that was received that I saw back in September of 2021. So this is an actual deal with actual numbers. And we are going to assume this is operator Q. So the property details, it's a 1991 bill. It had 278 units in Atlanta, Georgia. The business plan was to hold for 5 years. Value add was $300 per unit premium. Again, this was very common back in 2021. And the 3 underwriting assumptions that we're going to talk about for this deal is that the operator took a floating rate of bridge debt because they were doing a heavy renovation for this property. So they took a bridge debt at 4% plus SOFR, because bridge is usually floating rate, which is pegged to SOFR, the secured overnight financing rate. However, they didn't take any cap, interest rate cap, because they didn't see the need to take an interest rate cap at the time. In terms of rent projections, they were projecting 5% in year 1 to 2. And if you saw deals back in 2021, this was very common. I saw multiple deals in my inbox that operator was projecting 5%, 8%, or even 10% organic rent growth. So they did 5% in year 1 to 2, 4% in year 3 to 4, 3% in year 5. And your exit cap rate, because the market sentiment was at the highest it's ever been, they were projecting a 4.5 on exit. So they showed this to the investors, and what did they show? Their promised returns was a cash on cash of 4.6%, IRR of 19%. Remember that investor asking about the IRR of 19%? This is where it came from. The average annual return was 27%. Equity multiple was 2.4%. Again, this was not uncommon back in 2021. I attended multiple webinars where operators were saying, if my deal doesn't 2x in 5 years, I don't want to see it. So this was very common. So let's take a look at the assumptions. The first one was the debt. The second was the rent growth of both organic and value add. And the last one was the exit cap rate. And why am I highlighting the assumptions? The reason being, your underwriting assumptions will either fast track your investment goals or lead to your downfall. I'm sure there's a wise investor out there that once said that. So assumption number 1, floating rate, the debt that they took. So they took a floating rate. It was 4% lender spread plus SOFR with no cap. And you're asking yourself, why did they not take any cap on this property? And I'll tell you why. So at the time, this is an actual 1-month term SOFR forward curve. At the time, the SOFR curve all the way until the end of 2023 was predicting that SOFR would stay below 1%. So the operator did not feel the need to spend, which was quite cheap at the time, $30,000 or $50,000 to purchase an interest rate cap, because they wanted to get those sweet, juicy returns and maximize their returns. So talking about debt, multifamily financing, let's explore some of the main financing options. This is not a comprehensive list, but these are the ones that you typically come across. The first one is your agency debt. So this is your Fannie Mae and Freddie Mac. These are government sponsors enterprises. So you typically see them as GSEs. And one thing you should note is that they do not actually originate or service the loans. They guarantee loans that are serviced by Sallie Mae and Freddie Mac approved lenders on the secondary markets. And what they do is like they purchase these mortgages from lenders, package them into what's called MBS, mortgage-backed securities, and sell it to investors on the secondary market. They mainly deal with conventional conforming loans. And for that reason, they have specific criteria that these lenders have to follow, else they're not going to take over those loans. So they have loan limits that are set by the Federal Housing Finance Agency. And why are these common? Because they offer very competitive rates and terms. They offer fixed or floating rate with 5 years, 7 years, or 10-year terms. They do come with prepayment penalties for the fixed rate options. So you could see like yield maintenance or defeasance. And the amortization periods is usually up to 30 years. That's what's common. But for some of the recent Freddie Mac quotes, we've been getting like up to 35 years. And they can finance acquisition, refinance, or like a property rehabilitation if you're doing any renovations. The second one is your bank loans. So these are very common, excuse me. These are common for like smaller real estate investments. So typically less than 5 million. And existing banking relationships, say with Wells Fargo, Bank of America, Navy Federal, is very crucial in terms of securing this debt. And the loan terms can vary because based on that banking relationship you have, you can negotiate the interest rates, the amortizations, and the down payments. One thing to note with bank loans is they typically do not offer non-recourse. So in the event of a default, the borrower may be liable for the payments. The next one is your HUD loans. HUD loans are not as common, and the reason is that they have a long origination period, typically 6 months, and lenders are not going to wait, sellers are not going to wait for 6 months for you to close. It's provided by the U.S. Department of Housing and Urban Development for like new constructions, large rehabilitation projects. One of the benefits, if you can secure HUD loans, is that they offer long-term, up to about 40 years, fixed rate financing options and long amortization 40. So you would typically see 4 years loan term with 40 years, 40 years loan term with 40 years amortization periods. They offer incentives for energy efficient and affordable housing. You may even get tax rebates if you can secure a HUD loan. However, like I mentioned, they have long origination periods and they have strict regulatory compliance that you have to follow. Last but not least, bridge debt. And they stand for exactly what the name suggests, is to bridge you into stabilization. So these are typically short-term financing options for transitional projects. So if you're doing a heavy value add, they're typically 3 to 5 year loan terms. And they may serve as an interim before securing permanent financing once their property is stabilized. They do come with higher interest rates, and they're pegged against SOFR secure overnight financing. So it floats. So they're typically floating rate loans. There's an option, and it's always recommended to purchase an interest rate cap in order to limit your exposure in the event of an environment that we have like this with rising interest rates. They offer higher loan proceeds than agency loans. The loan proceeds are usually based on the loan to cost. So they can finance up to about 100% of your renovations. So you can see how with that leverage, it can boost the returns, which for our operator Q, they took a bridge debt and they did not take an interest rate cap. So they may include up to 100% financing, like I mentioned. So floating interest rates, it's to calculate it is the SOFR index plus lender spread. It used to be LIBOR, but has transitioned over to SOFR now. And you can always pull up the SOFR, the 1 month forward curve from Chatham Financial. That's what I used. It's very important. So what potentially went wrong? Again, I have no inside knowledge of this deal, but I do like numbers, and we can use numbers to tell a heck of a story. So remember, the first assumption they did is they did floating interest rates at 4% lender spread plus SOFR. And if you remember, the SOFR curve that I showed you, they were projecting SOFR was to stay below 1% for over 2 years. But I'm not sure if you've seen that movie, Along Came Polly, but in this case, along came Jerome Powell. So I'm going to take all of their assumptions and we're going to put it through Jerome's funnel. So starting with debt. So this was the initial projection. The 1 month when this property was purchased, say in September 21st, 2021, the 1 month SOFR curve was well below 1%. So if they had a spread, the lender spread of 4%, the max that we're assuming that your interest rate will rise to is about 5%. But what happened? Jerome Powell came by. So he started hiking. The Fed started increasing rates back in March of 2022, last year. So you can see how there was a change in the 1 month forward curve. And remember, this operator did not purchase an interest rate cap. And just a reminder, your floating interest rate is your SOFR plus the lender spread, which in this case was 4%. So this was their initial analysis when they were promising those juicy returns. Again, this was a 5-year interest-only debt. So all they had to pay for debt service was the interest. So their projected interest rates using the SOFR curve at the time was to increase at a highest of 5.5%. That was their max projection. However, what happened? We got into an environment of rising interest rates. Interest rates started going up. The 1 month SOFR curve started to increase. So by year 2, which would be mid 2022, the interest on that property was now 8.37 from 4.14. And in year 2, they were projecting that they were going to be paying about $2 million in debt service. They were now required to pay about $3.7 million, and it goes all the way if they were to continue to hold this property. What do you think happened to their cash flow? So this was the projected net levered cash flow for year 1 through year 5 from the original underwriting. Well, I can tell you it wasn't positive because their interest rate increased dramatically. And so they were already cash flow negative by year 2 and likely not able to service their debt. And again, this levered cash flow is a cash flow that the property generates that will be distributed to the investors. So first assumption, let's look at those returns. Remember those promised returns? With the changing debt environment, those returns start to dwindle. So cash on cash is now at 0.1%. That internal rate of return is now 14.3%. So it's not bad. The average annual return is now 17, and the equity multiple is below 2. And that's just the first assumption. So let's move on to assumption number 2, rent growth. Again, the market sentiment was at its highest it's ever been. This were their projections: 5% in year 1 to 2, 4% year 3 to 4, and 3% in year 5. In addition, so that was the organic rent growth. In addition, they had a value-add plan to increase their unit premiums by $300 once they were completely renovated. Rent growth. I'm sure everyone on this call have heard this from one webinar or YouTube channel. People will always need a place will always need a place to stay, so rent will always go up. So let's talk about rent growth. So it's the increase in the rental income over time. It's measured as a percentage of the change in rent. So when you see like 2% rent growth, that's like the organic rent growth. It's a key indicator of the health and performance of a real estate market or property. If you're investing in a property or location where rents have been trending down, then there is a probability that you're not going to generate additional income trying to increase rent for your property. There are several ways, but the 3 main ways I'm going to discuss how you can potentially increase your rental income. 1 is organic, 2 is the loss to lease burnout, and the 3rd is the value at premium. So organic. So this is your gift for owning a real estate, a multifamily property. So it's controlled by market dynamics without you doing anything to the property, no interventions or no improvements to the property. Just a matter of market dynamics, like increased demand. If you was in an area where there was an increase in jobs, so more people were moving to that location, then the demand for properties will go up, and you are likely to see that increase in organic rent growth. In an inflation environment, rents tend to go up. Not the case now, but typically rents tend to go up in an inflationary environment and just positive macro economic conditions. So your loss to lease, so this comes if you purchase a property, say an owner has owned their property for years, but they were not paying attention to the market and they just kept rents the same. So there's inherent growth, there's inherent delta between what that owner or the operator is currently renting the property and what the market is charging. So there is an opportunity from day one to close that gap, again, without doing any interventions. Just as tenants roll out, you can immediately achieve that delta. The last way, and the most common, is your value add for like class C and B properties, where you go in there, you improve the amenities, you improve the interior units, and then you increase the rent in their units. And the tenants are happy because they have better apartments, cleaner apartments, new amenities. So they're willing to pay the extra premium that you're charging. So what potentially went wrong? Again, we keep coming back to this question with your projections. Their assumption was that they were to go in, do a value add, increase the rent by $300 per unit, because that's what the market was asking. And based on the market at the time in 2021, where everything was going up, the market sentiment was at its highest, demand was high. They were projecting a 5% rent growth in year 1 to 2, 4% in year 3 to 4, and 3% in year 5. Along came Jerome. So let's put it through the Jerome funnel. So this was the initial projection. So 5% year 1 and 2, 3% in year 4, 3 and 4, and 3% in year 5. However, the market changed, rent started to soften. The organic rent that they had underwritten, they're not able to achieve. They're only barely able to achieve about 1% in the past year. And next year, they're projected to achieve just 1%, 2% the following year, and 3% in year 5, just given the current macro conditions. So do you remember those $300 per unit premiums they were projecting for those units? Well, they've only been able to achieve about $200 per unit, and they were renovated. They were underwriting a significant amount of units to be renovated, so about $100 average below the initial projections. So what do you think happened to their cash flow? This was the original underwriting. This was the projected net levered cash flow. Again, this is the cash flow before distribution to the investors. Well, I can tell you it's not great. You know, their cash flow continue to decrease because they're not achieving that organic rent that they were getting initially, and they cannot get the premiums that they were initially underwrote. And just to give you an idea what it looked like just after the tax assumption, I just want to highlight what it was before. And once you put in that rent growth, softening, and the debt, you can see that their cash flow has decreased significantly from projections. I hope everybody's still following. I know this is a lot of numbers. So if you are following, just drop something in the chat so I know you guys are still awake and nobody is sleeping. I know it's numbers. So we're now at two assumptions. So let's take a look at what the returns look like. Does anybody want to guess what the returns look like once we factor in the rent growth changes, adjustments, and the floating rate and the debt adjustments? Let's see, what are you guys saying? I love it. Okay, let's go. Well, so along came Jerome again. So now your cash on cash is 0.1%. Your internal rate of return is 0.4%. Your average annual return is 0.4. And your equity multiple, so they just about breaking even if they were to walk away for the investors. Again, the only thing being changed in this deal are their assumptions. All else stayed the same. This is assuming that they just wanted to get back what they went in and sell it for the same amount that they bought the property. Exit this. Sorry about that. Okay. So, what's going on? Sorry, what did I do? Okay. Before we continue, I just wanted to take this time to get 60 seconds of your time. We just want to talk about an exciting opportunity that we have for our community here at XSITE Capital. So I'm going to let one of the founders jump in and just tell you what we've been cooking and working on for a long time. And we're excited to share with the community.
All right, Manny. Thank you so much. Along came Jerome. I love that line. This has been an amazing evening. A lot of knowledge being dropped here. Everybody, if you've been following the multifamily space for the last few months, or if you've been coming to our meetups, you know that we are going through like one of the greatest moments when it comes to multifamily investing. There's about to be a significant wealth exchange in this space where you see, like the deal that Manny is explaining, there are a ton of deals like that are coming to you right now where the interest rates have gone crazy. I'm talking about great deals with strong fundamentals that the only thing that was wrong with is the debt that was taken on and some of the assumptions that were made at that point in time. So this is a good moment for everybody that has been part of our community, or you that have been sitting and thinking, I'm going to take action in multifamily, but you haven't taken that action. Now is the time to take the action and start learning. And we've been working really hard, anticipating this change in the market that is coming. We've been working really hard, putting together all the knowledge that we've gathered over the years. And I can tell you, Tenny, how much have we spent in mentorship and coaching over the years to get to this point?
Yeah, I don't want anybody to beat me over the phone. Like, where do you have all that money? A lot of money.
Yeah, we spent over hundreds of thousands of dollars in multifamily knowledge coaching, mindset coaching, anything that we could put our hands on just to help us grow and get to this point. And we've put all of that together in our course, which we're calling Multifamily 101, and putting it out to our community for you to gain the knowledge that is necessary to be a great investor and to be a great operator. For you that just want to go out there and invest in a bunch of deals, this course will help you make the right decisions so you do not fall into assumptions, optimistic assumptions, and knock on wood, lose your money on a deal like it happened to these investors. And for you that wants to be an operator, this course is a great point for you to get started, get the knowledge that is necessary to go out there and take advantage of some of these great deals that are coming. And we are offering this course. We launched the course, started offering the online course at $799, dropped it for the launch for $499. And we're offering this to our community. Anybody that's interested in taking that next step, now is the time to take action. Because going into 2024, you all have the opportunity to make a significant change in your wealth trajectory, and we'd love to be part of that journey as well. And before I wrap up, I did speak with our CEO earlier today, and for the first 20 people that signed up for this course, or actually for the next 2 hours, we're going to discount the course another 25%. So that $499, you get a 25% off for the next 2 hours if you go ahead and sign up for this course. We look forward to you joining us on this journey. There's so many pleasant surprises coming along with Multifamily 101. If you've been part of our community, you know we're all about giving value. So yeah, we look forward to giving a significant amount of value to you on this course. And I'll pass it back off to Manny to take it over.
And if you're interested,
and sorry, there's QR code and there's a link in the chat for anybody that's interested. Go ahead and sign up now so you could get your discount, and let's get it going.
Perfect. Thank you, Leslie. I'm excited to have you guys join our community and continue to learn and grow together. So I'll just give it about 5 seconds if you just want to take a picture of that QR code. The link has also been dropped in the chat. So let's get back to our property. So the third assumption on this property was cap rates. So the exit cap rate that they are underwritten was 4.5%. So yeah, there's more. So let's talk about exit cap rate. And I know someone out there is saying, oh, I know this one. It's the return I get if I pay all cash for a property. That's basically every new real estate investor. I can guarantee you that if you purchase this property back in 2021, whatever return you're expecting to get, you're not going to be getting. So what is cap rates? Cap rates is in multifamily and most videos you listen to, it's used as they use it as a return metrics. But cap rate is a terrible return metrics. It's a terrible metric to be used to define like a return metrics. What it actually represents is a barometer on the market. So it changes with market sentiment, goes up when the market is the sentiment is low, and it goes down in a hot market. And it is used to help assess the risk and potential of a real estate investment. Like I mentioned, a higher cap rate generally indicates a higher potential. Again, it's not a good return metrics, but it's very location based. Where cap rate is very useful, and the only part it's used in your analysis in multifamily is to calculate or to estimate the sale price at the end of your business plan. It can help you gain insights during your whole period, but the only place you use cap rates is to estimate your exit price. And one thing I want to mention is important to understand the difference between a market cap rate and a property cap rate. A market cap rate is a factor of recent sales. So all the brokers are going to look at all the sales at that property, at that location, similar vintage, say Class C properties sold within a 3-month period, and they're going to compare the NOI to determine what the cap rate or what investors are willing to pay per dollar of NOI for those properties. So it is independent. The market cap rate is independent of the property you're looking at. It's just based on recent sales on the market. 2 quotes that I really like, if you like reading numbers, I definitely recommend you pick up this book, Real Estate by Numbers by Jay Scott and Dave Myers. It says cap rate is a measure of how much investors in a certain market are willing to pay per dollar of NOI for a particular property. The second one being cap rate is determined by the market, the type of property, so like a Class B or Class C, the condition of the property, the age of the property, and the risk associated with owning that property. So cap rates gives you insights during the whole period of your property. It helps you assess how much each extra dollar generated at that property through, say, other income impacts your property's overall value at the end. So you can have an insight how much changes in cap rate will affect your property value on exit. And I want to show you a practical example. Say I purchased a property in South Carolina. This is a garden style apartment, 150 units. If at the time of purchase, my cap rate was 5%, if I'm able to generate just $1 per unit per month of additional income, so that's with 150 units, that's $1,800 increase in NOI, assuming expenses stay the same. My potential increase in property value on exit is about $36,000. So now let's look at that same scenario in a cap rate expansion environment. So what happens if my cap rate goes up 100 basis points to 6% on exit? That same $1,800 increase in NOI now only increases my value by $30,000. Still good, which just shows you how much powerful multifamily is. However, if you exit in on a cap rate compression environment, say you're from purchase, the market cap drops 100 basis points to 4%, that same $1,800 now increase the value of your property by $45,000. So you have to really understand how small changes, incremental changes in income can have such a significant impact on the value of your property. These are income-based businesses. It's all about income. So if you can increase the income of your property, you are likely to sell it at a higher value. Man, we got to keep on going. So what potentially went wrong with your third assumption? So it was a hard market. The market sentiment, again, remember, cap rate is a barometer gauging the market sentiment. So it goes up and down. In an interest rising environment where debt is more expensive, you tend to see cap rates follow interest. They're not directly correlated, but you tend to see cap rates go higher because, again, the sentiment is down. Investors are not willing to borrow at a higher cost. Leverage is negative, so cap rates expands. So the assumption, because they purchased this in a very hot market, deals with trading at 3%, 3.5%. So they're projecting the exit cap rate at 4.5%. Along came Jerome again. So now we're going to put in our rent growth, exit cap, and debt into that Jerome funnel. So this was their projection. They're going to exit at 4.5%, and they're going to sell these property at $293,000 per unit. Not unreasonable at the time. But what actually happened? Cap rates expanded. Interest rates started going up. So that same 4.5% property, it's now selling. Investors are only willing to pay at a 6% market cap. What do you think happened to the cash flow? Remember all green cash flow, those juicy returns? Well, it continued to go down. And one thing I want you to pay attention here is the year 5. So if you look at the year 5 and the net levered cash flow from their initial projection, they were projecting that they would collect. So this is the cash flow for that year 5 in addition to the sale price. The cash flow minus the sale price. It was like 28 million just cash flow after paying all debt on that property. However, once cap rates expanded, they're not generating enough income, one, to even service the debt, to or even sell that property at a high value. So cash flow drops. So the one in the circle, so that's when we just factored in the rent growth and the rent growth and the debt. Once you put in cap rates in there, the value, the cash flow and exit is significantly affected because, again, cap rate is only used in your analysis. It can give you insights throughout the whole period, but in your actual analysis, it's only used to calculate the exit price of the property. And your exit price is based on the income being generated at the property. This property was not generating any income. So that's why you see those negative net levered returns. Oh man, I feel bad. Anybody want to take a shot what the returns look like once we factor in all their assumptions? This is the last one, I promise. This is not anymore.
No more money.
Well, I can assure you those juicy returns are gone, right? So at this point, it's not even about the returns. At this point, if you remember the question that I started with, you got to pull out your PPM and trying to figure out where you fall in that capital stack, because there's a high probability, if the operator even still owned the property, that you may not be getting your money back. Because at this point, based on the debt service coverage ratio, the bank may already have taken the property. And that's how I believe we've been seeing a lot of these headlines. And it's not going to end because a lot of deals were taken with bridge debt, some without interest rate cap. And again, these are not made up scenarios. This is what is actually happening today in the commercial multifamily space. So they're not theoretical. These are things that operators are currently dealing with. And again, no one had a crystal ball in terms of how fast rates are going to be increased or rates are going to rise. But these are the challenges that commercial real estate operators are currently dealing with. So how can you protect yourself and your investors? Opportunities lie ahead, like Leslie stated. There's 250 billion in multifamily loans that's coming due. So there's going to be a lot of opportunities out there. But first, you have to educate yourself. Again, if you're following any mentors or any YouTube channels, they're telling you you can do an underwriting in 5 minutes or 15 minutes, you should go right now to YouTube and unfollow them. Underwriting is a very critical process. You can put it into an analyzer and be done in 5 minutes, but you have to understand the concepts. You have to understand why you're doing this, why you're doing those projections, why you're increasing the cap rates. You have to understand and be able to explain that to your investors. Because if you cannot explain that, then you're not being a good steward of their capital. So what are some things that you can do? The first one is consider, and this is what we're going through right now, consider how changing market conditions like a recession, which a lot of like macroeconomics economists are projecting for next year, or market sentiment in the case of cap rates might influence the feasibility of your different exit strategies, whether it's a refinance or a sale. You want to assess the impact of market conditions on the reversion cap rates. Do you think cap rates are going to expand in the sense that market sentiment is going to continue to go down? Or are you looking at a cap rates compression where you're projecting that interest rates, the sentiment in the market would improve in the next coming years? You always want to have multiple exit strategies. If your only strategy is a refinance or a sale, you want to see what would happen if at the end of year 5 you cannot sell that property. Can you refinance? So you want to do some sort of sensitivity analysis to see if different strategies would still make the deal pencil. You want to consider scenarios where rent growth decline due to market conditions or vacancies. What if you underwrite that same deal with 0% organic rent growth? How does the deal look? What if there's no value add? How does the deal look? You just want to have those in place. Again, you are not going to protect yourself from every single mishaps, but you want to have strategies in place, and you have to at least think about it when underwriting. This is very important. Debt is a tool, and you want to make sure you use the right tool for the right investment. If your plan is to hold the property, if you have a stabilized property for a long time, then sure, get a fixed rate, 30-year fixed rate debt. If you plan to exit in 3 years, do not put a 30-year term on a property, because you're going to be paying a significant amount of prepayment penalty at the end of that 3 years. So you want to use debt to your advantage and make sure you're using the right debt for the right property. If you do get a bridge debt and get a floating rate loan, you want to make sure you protect yourself and your investors by getting an interest rate cap on that floating rate. We talked about considering scenarios with rent decline. That's just a duplicate, and you want to stress test assuming higher operating costs and the impact of debt service coverage ratio. Some lender documents will have covenants in there in terms of the debt service coverage ratio, where the lender would say if your debt service coverage ratio on any year, not just an exit, drops below 0.9 or 0.8 or 1, they have the right to take over your property and sell it. Again, a senior debt, they hold the property collateral. So you want to look at your debt service coverage ratio, not just in year 1, but throughout your whole period. And again, this is our portfolio here at XSITE Capital. We currently have 168 million under management, and plan is to continue to build this alongside our community. And this is our investor community QR code. If you're trying to join our community, please text wealth to that number. Kayla would definitely reach out to you to connect, to learn what your investment goals are. You can also scan that QR code on the screen. And with that, thank you. And if you have any questions, we can discuss now. Stop sharing the screen. Cool.
And to add to that, I think Leslie mentioned, I don't know if you mentioned it briefly at the last talk about our mentorship programs. We have a mentorship program that, that is by screening only. For you to be able to get invited to it, you will have to schedule a call with all of our team members to have a conversation with you first. And then after that, then we can see if we're going to take you in as a student. But as part of the coaching program that we're going to be offering to our students comes Manny and Jerome Powell. So Manny is going to do a detailed underwriting as part of the group coaching, and the one-on-one is going to be a part of that whole program. If you're interested in that one-on-one or group coaching, so please go ahead. I think the link is on the chat. Click on the link and please join us. And we're going to go through the process of interviewing you. And if you're a good candidate for the group coaching or the one-on-one, we're going to go ahead and see how we can invite you to that program. Please, questions. If you have any questions, please go ahead and drop it in the chat. And I'm sure Manny is ready to answer those questions.
Hey, Manny, I got a question for you. When it comes to rent projections, I know that was one of the 3 underwriting assumptions that sample deal went wrong. When you're doing your analysis and you're projecting rent growth, whether it be like organic or not, what are some of the resources that some people in the audience can use to project rent, or if they're passive investors, to make sure that the operator is projecting rent correctly?
We use CoStar. So you look at CoStar projections and you just want to look at historical. Utilize your property manager. They have experience in that market, so they understand the different cycles. So CoStar, just reading different publications. I highly recommend everyone subscribe to like Pensford, CBRE. They put out quarterly reports just about the change in real estate markets. So that gives you insight in terms of where rents are going to go for different locations. But CoStar also does a good job in projections. And that's why I say you also want to do a sensitivity analysis to just see what the returns look like in the event that rents are not going to increase organically like you're projecting.
Thank you for that.
Sure, no problem.
Nicholas, he just dropped in the chat. Thank you for your presentation, Manny. Can you recommend any good books? Nicholas, he did mention Real Estate by the Numbers. I got it right here. Definitely a good read. Manny, is there any other books that you would recommend?
The 2 main ones that I really like is A Hands Off Investor and Real Estate by the Numbers. Real Estate by the Numbers is heavy in numbers, but I like it. I understand it better than reading a book with a bunch of words. I like numbers better. But you learn a ton in terms of the concepts. And again, when it comes to underwriting, I always tell people, I think the understanding the concepts is the most critical part. I think a lot of people tend to just jump in and just grab an analyzer and just say, hey, I'm going to put this in here and see what it comes out in the end. But I think the first step you should start with is actually understanding the concepts and understanding why you're doing. And for me, once I started taking modeling, like financial modeling classes, I think I learned the most because I had to understand how to build a financial model. And in order to understand how to build a financial model, I have to know what all of those different metrics mean and how they work. So if I look at a deal, I can easily pick out like that doesn't make sense because I know what's happening on the back end. So, but the 2 books I would recommend is Hands Off Investor and Real Estate by the Numbers.
So Manny, I have a question for you. So if somebody wants to learn underwriting, I know you like numbers and you go through, financial models. Will they need to learn those financial models in order for them to be able to underwrite deals, or them just joining your class and participating in that? Would that be enough for them to get the knowledge they need to be able to underwrite a deal and submit offers?
Yeah, you don't need to take financial models. You just have to understand the concepts. So if you just take a class or a course that's heavy on the concepts, again, the actual analysis through the analyzer is the easiest part. I think the most critical part is understanding why you're doing that. Why are you projecting 2% rent growth? Why are you doing a cap rate expansion? Why are you doing a cap rate depression? As long as you can explain that and understand the concepts, what is what, understanding the floating rate, why do you need an interest rate cap? So it's understanding the concepts. You don't need to take a financial modeling. I wanted to take a financial modeling because I have an engineering background and I like building versus using. So for me, it just made sense.
Sounds good. Thank you.
Manny,
Man,
you want to? I think Manny is being modest, a little bit. I started when we started XSITE Capital. One of the most difficult challenges we had was underwriting. Tenny refused to underwrite, although he claims to be an engineer. So I, a healthcare person, had to figure out how to underwrite. And so I learned from somebody that the fastest way to learn something is to teach others. That's why we started the underwriting class, and that has been running for about 3.5 years now. And Manny took it over and just took it to a whole nother level. And he has created this tool that, boy, I tell you, it as an underwriter, it is magic. If you're new to multifamily, underwriting is probably one of the most difficult skills, but as busy professionals, we had to come up with something that works for us, that accounts for the time that it took to underwrite a deal so that we're able to go through many deals. And Manny came up with something that is amazing. Manny, I don't know if you just want to tell everybody about the tool that's coming. That's going to be part of the program as well. And I think you're going to be launching that separate too as just an underwriting course. So if you just want to dive into that a little bit and how people can use it to underwrite safely in this boom that is coming with opportunities.
Thanks for that, Leslie. So when I started underwriting, one of the most challenging things for me was just the time that it took to do a lot of the repetitive work, and that's like cleaning up rent rolls, cleaning up T12, and just trying to understand, have a cleaner, just simplified analyzer that you can take. It doesn't matter who you are, but you can easily explain like a companion in your underwriting journey. So I felt like that's what was lacking in the market. I was doing a lot of repetitive tasks. So what I started building back in 2021 is an analyzer. It's a very Excel, similar to all the analyzers that you've seen out there on the Excel format. But it significantly simplifies the underwriting process in the sense that it cuts down the time that it takes to analyze the rent roll. So it does all the analysis for you just by dropping your rent roll in there, as well as the T12. There's T12 mapping options in there that just simplifies the whole process. It will be coming soon, first quarter of next year. So currently working on that. If you want to join the wait list, you can go to MS Analytica. So that's MSANALYTICA.com. So that's MS Analytica, which is for Microshift Analytica. And once it launched, you get more information on that. But the aim definitely is to simplify the underwriting process. It's currently being beta tested right now. That's what we currently use, and it's been working magically for us. So can't wait to get it out there to the community. And like Leslie mentioned, it will come along with an underwriting course that's being finalized now. So it will be a detail, what I talked about today, several hours, multiple hours, just discussing the concepts and the practical usage of how to underwrite properties. And it's going to be, like Leslie mentioned, as part of the XSITE program. If you join that program, he's going to be part of it as well.
Yeah, we had to squeeze Manny's neck to get it in the XSITE program because that program alone, that underwriting tool alone is so much value. I have no idea. It's so powerful. So for all of our first cohort of students, joining in the group coaching and joining in the one-on-one mentorship for those that qualify, you get access to this, and hopefully you use it to close a bunch of deals next year and build wealth for you and your community as well.
Okay, guys,
And Manny,
I have to run. I have a critical doctor appointment that I have to run to right now. I should be able to join in about 10 minutes from my car if you guys are still on, but I have to kind of beat the LA traffic going to Newport. So
all right. Thank you, Manny. This has been like a really, really powerful session. We still have some people, a bunch of people here on the call. Please drop your questions in the chat if you have any questions. We have the links here for the microshift for the course. Guys, take advantage of the discount and book your spot right now. And for anybody that buys the digital course and ends up deciding to do like the group coaching or any of the other advanced programs, ends up getting selected for that, you get refunded for the group coaching as well. So again, this is our way to build more XSITE capitals in our community for people that are serious about taking the next step. So let's do it. We're excited to get on this journey with whoever decides to join us. Do we want to move over to the networking session where we have people just jump up and introduce themselves?
Yes. Yeah, please. This is the part where you can come and talk about yourself, what you do. And I think we usually go by folks that are on video. I see Manny is resting on the bed. You can jump on and share about who you are. If you need help with anything, we're here to support. So please feel free to come on video. We don't bite, and just share a little bit about yourself.
You called somebody, I think you called Manny.
Yeah, there's Manny St. Louis up there.
Manny from St. Louis, talk to us. What's going on in your world? I guess Manny is shy. Who else is on the call that wants to introduce themselves?
Always been on our calls, always supporting.
Dr.
Thank you all for
Michael,
joining.
thanks for being here again. Dr. Nkem, thank you for being here. Naomi, thank you for being here. Delano, Nicholas, Johnny, Lauren, MG, George, Nde, thank you all for staying and sticking with us to the end. Again, we continue to provide value to the community, and we always appreciate you guys being here. If we don't have any questions and nobody else wants to come on camera, then I guess we're gonna give everybody's time back. Oh, Mr. Nde came on camera, so he's got something to say. He says, "Grind, hustle, and execution." I love that sign. Go for it, Nde.
No, I was just saying hello. Great work. Great work with all that you're doing with the course and whatnot. Of course, I also went through it. Definitely very detailed. So anyone who is looking to and thinking about taking the course, stop thinking and just take action.
Thank you for that
Thank you.
vote of endorsement, Mr. Nde. All right. Anybody else? Okay. On that note, we'll wrap it up. Thank you all for taking the time to spend this evening with us. We don't take it lightly that you're taking time out of your busy schedules to be here with us. We appreciate you. And we continue to deliver value every time we come in contact with our community. Again, thank you for the opportunity. And you guys all have a wonderful night. And to the whole XSITE team, thank you guys so much for all the work you put in to make this a possibility. Thank you.
All right, thank you.